Well, let's turn to discretionary stocks. The Invesco Leisure and Entertainment ETF has outperformed the broader market over the last 3 months. The top stock in that ETF over that time, Royal Caribbean, up a whopping 83%. But our next guest is downgrading the name, I should say, to hold, calling it a, quote, not an easy decision, nor one we take lightly. So joining me now is the analyst behind the call, Patrick Scholes, Lodging and Leisure Managing Director at Truist Securities. Patrick, it's great to have you on. So why the downgrade?
Great. Thank you, Morgan. You're absolutely right. Not an easy decision. This has been one of my favorite names over the last several years, and not only outperformance this year, but the last 2 years. So why the downgrade? Well, number one, stock has had a great run here, but it's also combined with our research showing, hey, things in the cruise industry are decent, but certainly not as good as they were entering the year. And when I talk about decent, I'm referring to the booking volumes here. To quantify that, as we look at the booking volumes for the industry over the last couple months, they've been up low to mid single digit year over year. Not a bad level, but if we go back how they were entering the year, you were looking at roughly growing at a rate of about 20% year over year. So certainly we're seeing some normalization. That combined with a stock that it's trading at on valuations at all-time high multiples, I just couldn't justify my buy rating anymore. And again, hard decision, because it really is a great company that has really come up with some creative ideas and executed on those as well.
Yeah, you just used the word normalization. And I just wonder, does that mean that consumers are pulling back, or that we're just getting back to more normal patterns that we saw, maybe even going back to before the pandemic?
Yeah, I would say it's actually a combination of two things. One, normalization in the sense that it was really cruise companies and cruise vacations that were late, very late to the game as far as recovery. I mean, they were really the last to recover here. And on top of that, you do have consumer confidence down, obviously, from where it was entering in the year. And I think it's sort of the combination of those two factors where we're seeing booking trends that are more similar to, say, pre-COVID than they were certainly 6 or 8 months ago.
It's interesting to read your call today, because on Friday, the American Express CEO post-earnings made the comments that while spend in some of the travel categories like airlines and lodging was soft overall, that they're seeing spending was still a quarterly record. We are starting to see this in different parts of the travel trade, if you will, this softening after a number of years of just really strong results. If that money's not going into travel and lodging, and perhaps not so much into cruising anymore either, where is it going? What do you like here?
Well, what do I like here? Well, I would say within cruise, there's definitely a catch-up name here, and it's been certainly the underperformer would be Norwegian Cruise Lines. And then within hotels, I like Hyatt Hotels. Hasn't quite performed as well as the outperform in the group Hilton. As I've been telling clients, we do a lot of research on underlying travel trends, and they've been pretty mediocre and lethargic. I wouldn't say there's anything I'm really pound the table like I was, but there's still some relative value names. Again, Norwegian Cruise Lines, secondly being Hyatt.